There's something strange happening on the edge of American finance. The headlines scream about tariffs. Inflation buzzes in the background like a mosquito in a silent room. And somewhere behind the Mar-a-Lago gates, a new plan is taking shape. A plan that proposes something that hasn't been seen in modern U.S. financial history. A 100-year U.S. Treasury bond. Is this financial engineering? Or fiscal illusion? Could it be a stealth default, or a stroke of genius? Welcome back to FluxFolio Finance. Today, we explore one of the boldest, and most debated, ideas of 2025. Let's unpack what Trump's rumored 100-year bond proposal means for the Treasury market, foreign debt holders, inflation, and the global financial order. Let's start with the foundation. The U.S. Treasury market isn't just any financial system. It's the heartbeat of global capital. Every mortgage rate, car loan, corporate bond, and sovereign reserve is tethered to it. And this heartbeat has been irregular lately. In April 2025, Treasury markets trembled. Yields on the 10-year surged to 4.59%, triggering fears of a liquidity freeze, a rerun of the 2020 dash for cash. Volatility exploded. The MOVE index, a measure of bond market turbulence, hit an 18-month high. Hedge funds scrambled as their leveraged basis trades unraveled, some facing margin calls. The bond market, it seemed, was coming apart. But now, in May, a fragile calm has returned. The 10-year yield has dipped to around 4.21%, not a crisis, but far from comfortable. The 30-year? Still elevated at 4.68%, flirting with the 5% line. Worries about 6% yields and foreign dumping still circulate, but these are more noise than signal. So what happened? The answer lies in Trump's 90-day tariff pause, announced in early April. A temporary truce in the trade war cooled market nerves. But the structural strain remains. Here's why: the United States is staring down a tidal wall of debt. And that's where the 100-year bond idea comes in. Previous estimates said $3 trillion would mature in 2025. But updated figures now put the real number between $7 and $9.2 trillion. That's nearly a quarter of all marketable U.S. debt, due this year. And much of it is short-term, Treasury bills with weeks or months left on the clock. The math is ugly. These bills were once financed at 1 to 2%. Today, new issuance comes with yields between 4 and 5%. That delta, combined with a $1.9 trillion budget deficit, means interest payments alone could surpass $1.1 trillion in 2025. This is the fiscal trap. And that's why the idea of ultra-long debt, like a 100-year bond, has entered the conversation. But let's be clear, no such bond exists yet. No formal proposal has been issued by the Treasury. No mention in the latest Treasury Borrowing Advisory Committee reports. The only spark came from vague public discussions referencing the idea of extending maturities. Yet the rumor persists. Why? Because it feels plausible. Because the logic seems simple: stretch your obligations across a century. Lock in rates before inflation spikes. Kick the can, not just down the road, but across generations. It's tempting. But it's also dangerous. Let's explore why a 100-year bond could be a fiscal illusion. First, long-dated bonds are incredibly sensitive to inflation. A mere 1% rise in inflation expectations can wipe out 15 to 20% of a 30-year bond's value. A century bond? Even more. And inflation is not sleeping. Tariff-driven pressures are mounting. Recent inflation surveys pegged one-year inflation expectations at 6.5% and 5 to 10-year expectations at 4.4%. That's well above the Fed's 2% comfort zone. Meanwhile, the Fed is stuck. Core PCE inflation is forecast at 3.2% by Q4, which means no near-term rate cuts. Fed funds remain between 4.25% and 4.50%, and that's assuming things don't worsen. So who wants to lend to the US for 100 years? At 4%? Not foreign governments. Not when they're quietly trimming their positions. Since late 2024, foreign official holdings of treasuries have declined by about $78 billion, now hovering around $2.87 trillion. Japan and China still hold over $1.8 trillion combined, but their share of total treasury debt has fallen from 50% a decade ago to around 30% today. They're not dumping treasuries in a panic, but they are diversifying. Poured gold. Poured shorter maturities. Poured flexibility. Would they roll their holdings into a 100-year instrument? Highly unlikely. What about the private sector? Could domestic investors pick up the slack? Sure, up to a point. U.S. banks, money market funds, and hedge funds now hold over 27% of treasuries. And they've been active in recent auctions. In fact, the 10-year Treasury auction in early April saw a solid bid-cover ratio of 2.67. Foreign demand was strong, much of it from indirect bidders, including central banks. But here's the key, they're buying shorter-dated bonds. Not 50 years. Not 100. Because while demand for safe, liquid debt remains, the appetite for century-long bets is thin. Especially when inflation looms, and fiscal policy looks more like a poker bluff than a budget. Let's talk stablecoins. There's a popular narrative that Tether and Circle, the giants behind USDT and USDC, are absorbing treasury debt like never before, with claims of over $100 billion in holdings. Not quite. Tether's Q1 2025 reports show $91 billion in U.S. treasuries, almost all in short-term paper. Circle's USDC has about $25 billion in reserves, also mostly short duration. Combined? Yes, they are meaningful players. But not the cavalry. They buy treasuries to back their tokens, not to fund America's century-long debt dreams. They're not here to roll $9 trillion in maturities. So where does that leave us? With a treasury market that's stable, but still stressed. Yields have cooled from April's panic. Basis trade unwinds have slowed. Repo rates are steady. But the risks remain. The U.S. has over $7 trillion to refinance this year. The Fed won't cut rates soon. Foreign buyers are easing away. Inflation expectations are sticky. And the grand idea, of 100-year bonds, is just that, an idea. Untested. Unannounced. And deeply vulnerable to inflation. Let's say the U.S. issues 100-year bonds. And let's say they work, for a while. What happens when inflation runs hot again? When the next crisis demands higher rates? When buyers balk? A 100-year bond that looks like genius today might look like default in disguise tomorrow. A commitment to repay, delayed beyond the horizon of memory. And if trust erodes, it's not just a bond that breaks. It's the dollar's role as global reserve. It's America's ability to finance war, crisis, and empire. That's the real cost. So is Trump's 100-year bond a stealth default or a stroke of genius? The answer, like the bond itself, is long and uncertain. In a world addicted to short-term thinking, it's tempting to push the pain into the future. But financial history punishes those who ignore the math. Inflation eats paper. Confidence breaks faster than it builds. And no one, not China, not Tether, not the Fed, wants to hold the bag for 100 years. At FluxFolio Finance, we'll keep watching, questioning, and decoding this moment in real time. Thanks for tuning in. If this deep dive helped you understand the Treasury market better, hit that like button, subscribe, and tap the notification bell so you never miss a crisis before it becomes a catastrophe. Drop a comment. Would you buy a 100-year US bond? Or is this just a fiscal mirage? We'll see you in the next one.